Today I'm going to teach you guys about the money multiplier method, otherwise known as infinite banking. And I'm going to map out the millionaire mystery. What if you could get all the money back for every purchase that you've ever made and create wealth through your own debts and expenses that you already have? If you're like most Americans, you've probably spent most of your adult life paying the banks, creditors, expenses, and at the same time watching your retirement fund and your legacy dramatically fluctuate or evaporate in the markets. You've been taught how to give up control of your finances. You've been taught how to assume risk, and it's costing you your financial freedom. The wealthiest people know differently. The multimillionaires, the billionaires, they do things differently. And what I'm going to expand on today in this presentation is a 200-year-old strategy that is used by the wealthiest to eliminate their debt, to minimize their taxation, and to leave a legacy. And I'll show you how to do all of this without taking on any more risk, without working any harder, without changing your cash flow, and without losing control of your finances. This presentation today is going to show you how you can become the bank. But before we do that, you've all heard the expression, if it sounds too good to be true, it must be. And that's what I thought as well when I first heard about the money multiplier method. How many of you have ever wanted more money for just about anything at all? If you said yes to any of those questions, the answer is you're in the right place. Today I'm going to share with you a little known but powerful wealth strategy, a wealth strategy that will completely change your financial future, just like it changed mine. And today we'll talk about your money. We're going to talk about your wealth. We're going to talk about how you can live just like the wealthy using their exact techniques. And we're going to cover exactly how you can keep control of your money and how to build wealth and how to keep your wealth in your family. And I'm going to show you how to pay less. And I'm going to show you how to pay your expenses and your overhead. But most importantly, I'm going to show you how to recycle and recapture all of the money just like the banks do. And this presentation is going to be a little bit of out-of-the-box thinking. And I'm going to challenge you guys to keep an open mind throughout this whole presentation, because I'm not selling you anything here. I'm simply showing you the path and the things that I've learned so that you can change your financial future too. Throughout this webinar, you're going to have questions. So I'd like for you guys to hold your questions, maybe write them down. And at the end, you're going to have the ability to meet with me or my team and talk about those. Today, we're going to talk about how to become the bank. But a question I often get is, why would I want to become the bank? I want you guys to think about that question throughout this presentation. Today, we'll talk about money and opportunity. So, we live in uncertain times, and your financial future does not need to be that way. You have to take back control of your funds. I'm going to take you on a journey to show you an over 200-year-old system that is the most powerful way of saving, creating, growing, and preserving wealth than anything else I've ever seen. And you don't have to work harder, longer, or change anything except where your money goes first and how you view banking. Would you guys agree that we're at extreme highs right now in the market? Can that go on forever? Probably not. So are you guys prepared for when it doesn't continue to go that way? I really think that the most amount of millionaires and billionaires will be created over the next decade. And the largest opportunity of our lives will probably be over the next decade. But I also believe more that people will lose everything. And they won't be able to retire the way they want. And there's probably going to be more broken dreams than there are that are achieved. So are you guys prepared for that? Today is your first step on the journey to wealth and success for your family and your family for generations to come. So let's talk a little bit about statistics. You guys are on this training right now. So you guys are what I call the 5%. You're a part of the 5% because you're here on this webinar. And that's awesome. You genuinely should give yourself a pat on the back for trying to learn different strategies to help your family. And now if I were to go around and ask 125-year-olds, a bunch of people in my generation, and ask them if they would be wealthy and successful by the age of 65, or if they would be, probably every one of those 25-year-olds would say yes. I wouldn't even be able to get the question out fully. They would be excited about that. They would say immediately, of course I'll be. Why do I have to wait till I'm 65? However, something changes. Something happens from when you're 25 years old to when you're 65. This will change the whole dynamic. 5 out of 100 people will be financially secure at retirement age. According to the Social Security Administration, they're the only ones that will be financially secure at the age of retirement. And I'm not talking wealthy or comfortable. This is just secure. Think about that. In the United States, the land of opportunity, in this great country we live in, how many of you would agree that there's something wrong with that? Only 5%. That means that 95% of people are going to be working until they're 70, 80, taking on second jobs just to pay their bills. Social Security is not going to be enough. And they're not doing that because they want to. I mean, they're doing it because they have to. Now, before you all get discouraged with that and start worrying about your finances, I just want you to know something. You know, I want you to know that by being in this room, being on this webinar, you are the 5%. The biggest difference between you and the 95 is your willingness to invest your time, your money, your effort, and your energy to learn something new. So how many of you guys are excited to learn about some 5% stuff today? So why aren't more people successful? A lot of factors come into the financial side and the mindset side. Obviously, taxes, inflation, volatility. When you get that paycheck every single month, what comes out of it? Your taxes. What you have left over, you use for expenses. Whatever you save is not going to be put somewhere where it's going to be losing to inflation and volatility in the market. And with that, it's going to be hard to build that financial success when we have other things, outside factors coming into our brains and our families. Things like the status quo, fear, and life. Things come all the time. We had COVID a couple years ago. That was not in anyone's radar. That hurt a lot of families. Not to this, things like that, not exactly COVID, but things pop up all the time that are going to affect our life. And so with the wealth killers we have, it's even more difficult to build wealth after that with the mindset and the fears that we have in America. So this is Chris Naugle. He's America's #1 money mentor, and this is my favorite quote from him. He says, "It's never about your actual resources. It's about how successful you can be." I'll get to Chris in a little bit, but just keep that quote in mind. Another quote I often think about with this strategy is Will Rogers, when he says, "The problem in America isn't so much what people don't know, it's what people think they know that just ain't so." A lot of what we've been taught about money may not actually be the truth. And so I need you guys to keep an open mind, because in this webinar, I'm going to challenge the way you think about money. So you guys know who learns quickly, right? Kids. Kids learn very fast. When you're a kid, you get a bicycle and you learn how to ride the bike. It takes a little bit, but once you have it, you got it. You can ride a bike at any point the rest of your life. And you know, when you're riding the bike, if you turn your handlebars right, you turn right. If you turn your handlebars left, you go left, right? So, but what would happen if your bike didn't work that way? What would happen if your handlebars turned right and you went left? Or you turned left and you went right? This screenshot right here is from a YouTube video called Backwards Bicycle. It's an experiment someone did. I'd highly recommend the video. You guys should go and check it out. It's a little experiment where this person, he's an adult, knew how to ride a bike, obviously, and he wanted to challenge himself. He swung the handlebars around so that they were in the reverse. And whenever he would use the handlebars and it turned left, the bike would go right, and vice versa. And so in this video, you'll watch him. He starts to get on the bike, tries to pedal, and he falls. He gets up again, and he falls. He can't do it for, I think it was like hours. He couldn't figure out how to get moving on the bike because his brain's been trained to go the same way. Once he finally broke that cycle and started riding the bike the opposite way, he was fine. And then when he tried to go back to the regular way of riding a bike, he couldn't. Same problem. He couldn't get his mind to go back to what it was before. I bring this up because when you learn something one way, it's very hard to change. And the same is true with money. Since we were little, we've been trained how to think about money. But what would happen if I told you that what you were taught is wrong? It'd be very difficult for you to change to the new way of thinking, wouldn't it? But it isn't impossible. Eventually, you'll be able to learn how to ride the backwards bicycle, and you'll never be able to look back. So earlier I had mentioned that a lot of you are going to think that this is too good to be true. And what do we do when we hear something's too good to be true? We ignore it, we walk away, we disregard it, right? Well, if this 200-year-old concept is too good to be true, then why is it that the wealthiest people use this? The Rockefellers, the Rothschilds, the Stanley family, the Morgan family, Walt Disney. I could go on and on. And not only that, why is it that it's talked about in some of the most popular books by some of the most popular authors? Books like this one, Second Chance by Robert Kiyosaki. This book talks a lot about this concept. And what about this guy, Tony Robbins? In section 5.2 of his book, he talks all about this strategy. And then my last couple favorite books, Becoming Your Own Banker by Nelson Nash. I would highly recommend that book if you're trying to learn this on a deeper level. He's the founder of the concept. You can find his book anywhere, just like the others. And these last two books are from Chris Naugle, the man I mentioned earlier, who's kind of my mentor in all of this. It's his guide to learning infinite banking and this money multiplier method. So a little bit about me. This is me, and this is all that matters to me. It's my wife, Anna. And hopefully over the next few years, as I build on this presentation, there'll be more little ones in this photo with us too. But we live in Southern California. We love to be outside, love to surf. We travel a lot as well. And we're second generation investors, real estate investors, business owners, infinite banking practitioners. And over the past few years, I've bought over $5 million worth of real estate. I've been building a real estate portfolio. I've been teaching this concept, and all these strategies and ideas coincide together. And that's what I really want to share with you guys today, is how that all happened for me, and how that's changed my life, and what this concept can do for you. And so to continue on that story, this is my dad here on the left, and on the right, it's him and I filming a podcast. His name's Greg. He has lent over $1 billion in real estate. He has been around any financial guru you've met, and he speaks on stage teaching about retirement accounts and how you can be in control of your retirement funds and how you can self-direct. And so he has taught me this concept, and he's had this strategy been going on in his life for a long time. And once I started learning from him, I wanted to dive in deeper and find out exactly where he learned it, and understand every aspect of it. And so earlier I mentioned the guy, Chris Naugle, on the left. Him and my dad have been business partners for over a decade. And so I went to Chris and I said, Chris, I want to learn this concept. What can I do? What can I do for you? What can I learn from you? And he just gave me his whole, library of books and videos, and I watched and learned everything I could. And so I still work with Chris to this day. But Chris was basically a financial advisor. He was in the rat race on Wall Street, and he learned about this concept from a mentor of his. He loved it, believed in it after understanding it longer. And he's since then started his own company teaching this concept, and he's been crushing it. He's, I think, the #1 producer of this strategy in the entire country. And this is me and him a couple weeks ago in New Zealand. So just so you guys understand, all these concepts and all these ideas don't come from me. They come from other people who've learned from other people. And I'm just here to share with you guys that experience. So let's talk about the mysteries of money. What's the definition of money? All right, money is just an exchange, or sorry, just a means for exchange, right? That's all it is. Money for food, food for money, money for car, car for money. Nothing more than just a means of exchange, right? So, and then if I were to ask you about what company do you guys know of that uses compound interest, what would you say? Well, most of you would probably say banks, Wall Street, investors. Well, I guess investors aren't companies, but you get the point. The answer is not one business. But let's focus on banks, because that's the most common answer. Banks don't make compound interest. They charge you compound interest. For example, if I were to give a $20 bill to the teller at the bank, do you think they're going to take that 20 bucks and go put it on a little box with my name on it in the back? No, they're not. They're going to put that money in motion immediately. Banks don't use compound interest. Banks keep their money in motion just like you should. But you've never been shown how to do that. You've been taught to park your money and leave it in someone else's control. You've been taught to park your money and leave it in someone else's control, but today that has to change. Because if I asked you this question, is $1 worth more today or in the future, what would you say? You'd probably tell me that the dollar is worth more today, or at least I'd hope you'd say that. If you don't think that's the case, then think about how many candy bars you could have bought with a dollar 20 years ago compared to today. And then our tax is going to go up or down. What's better? Would you rather pay taxes on the seed or on the harvest? Taxes will go up always. And if they don't, they're going to find more crap to tax us on. And wouldn't it make more sense to pay tax on the seed versus the harvest? The answer is yes, of course. However, you don't practice what you teach, because chances are all of you have some sort of 401k or other employer-sponsored plan. And what you're actually doing is when you put those dollars in the 401k, you're actually giving up today's dollars in exchange for weaker dollars in the future. You're actually compounding the tax because the tax is always going to be there. And when you pay the tax on that money someday, you're going to have to pay tax on a larger amount. You're not paying tax on the seed, you're paying it on the harvest. But if you did pay tax on that seed, you'd pay taxes on the dollar today and not on the future dollars. And this is the funny thing, because what people have been taught to do is just give up control of their money, just like I explained a second ago. We literally have been taught to do things with money that we would never do with things that money buys. Let me give you an example. Do you ever go out and buy a loaf of bread from your local grocery store and bring that loaf of bread home, open up the fridge or the freezer, put it in the freezer door, and wait 5, 10, 15 years, and then come back, open the freezer door, take out the bread and look at it and say, delicious? No, you won't. It would be freezer burned. You would never eat the bread. So what about this? Would you ever go and buy a brand new car and wait 5, 10, 15 years to drive that car? No, you would not. But that's exactly what we've been taught to do with our money. You've been taught to give up control of your good dollars today for weaker dollars, taxed higher dollars later. And if you want to be good at money, then you need to start changing who's in control of that money. You're giving up control of your good dollars today for weaker, higher tax dollars in the future. And if you want to be good at money, then you need to start changing who's in control of that money. And let's say you get a match at your 401k, because people rationalize all the time why they put money in their 401ks. Oh, it's a tax deduction. You're paying taxes on the harvest, not the seed, right? But they also say, but yeah, Carson, I get the match. Well, let's use that loaf of bread example. If I went to the store and bought a loaf of bread and came back 5, 10, 15 years later, I opened the freezer, and now I have 2 freezer burnt loaves of bread, would you be happier? No. If I were to ask you guys, what's in your retirement account, or what do you know about your retirement account? I can tell you what you know. You know very little. You know whether you are maybe in a conservative, moderate, or high risk tolerance. And you certainly know that when you get the statement once a year, whether your balance is going to go up or whether it went down. That's all you know about your 401k up to this point. And that's how you've just been taught about money. You've been taught to just accept the traditional way of thinking about money. But to truly build generational wealth, you need to challenge those old concepts, and you need to understand how money really works. So let's dive in. Principles of money. So let's say you go to the bank and you go to the car dealership and you want to buy a car. You want to buy this car for 25 grand. And don't get hung up on the price. It's just an example. But let's say you go in and you've saved up the 25K to go buy your car. So you walk into your conventional bank, and I'll play the role of the bank. You say, hey Carson, I have 25 grand. I'd love to purchase this car. I would say, well, you're earning 4% in your savings account right now. It's a really good rate. Are you sure you want to take that money out? And let's just pretend, you have a really good bank that pays you 4%, because that's unheard of, right? And you come to the bank and you say, well, Carson, I just want to take out the 25K, and I know it's earning 4%, but I want to buy the car cash because it's better than paying interest and payments. And I said, well, as a banker, I'm going to say, no, don't do that. Instead, I'm going to give you a loan for $25K to buy that car. And I'm going to charge you 6% interest. And I'll use your bank account as collateral for the 5-year loan. And I'm going to tell you, well, but our bank, I'll tell you, what we'll actually pay you more interest than you would pay on the car loan during that whole period of time. And I'd say, well, how, or the person coming up to me would say, well, how is that even possible? And in this example, the banker is telling the truth. You will make more money over that 5-year period, earning 4% on the $25K in the bank, than you will be paying 6% on that car loan over the same time period. Doesn't matter whether it's a 3, 5, 6-year loan. Is that really true? Is that possible? Can you make more when you're paying 6 and making 4 on your money? You're probably saying, no, how can I earn more paying 6 when I'm only making 4? You would think you're at -2, you're losing 2%. But I'm telling you guys, that's not the case. And I'll show you why with math. At 6% for 60 months, 5 years, your car payment will be $483 a month. At 4%, in your bank over here on the right, at 4%, your account balance after 60 months, well, I'll even go back to that. Your account balance will be $30,525. But the total payments you would have made for the car over that 5-year period would have been $28,999. You would have paid more than 25 because the interest, but the entire time you're paying your car balance down. So the interest you owed was less and less, whereas your 4% in the bank is compounding on itself, making more and more. So the car balance is going down while your money balance in the account is going up. That comes from the simple interest you're paying down and the compound interest that's growing. Our minds are not trained that way. They're not trained to think about money or math that way. So we have to start learning how money really works. This exercise proves to you you can make more money all day long by paying 6% and earning 4%. In this example, after 5 years, he would have made $1,526 by putting his money in the bank and making 4% and getting a loan for 6 instead of just buying the car cash. So do any of you guys know the actual rate of return? Well, the average rate of return in the stock market over the past 100 years? It's 7%. So let's ask this question. And I'll give you a little story too. So would you guys invest 10K with me if I could guarantee you a 25% annual rate of return? And I'll take a 2% management fee. I'll be generous, right? I'm going to promise you, I will give you the lien to my house. I don't care. I know as a financial advisor, I can totally make you 25% each year, okay? And let's just say you feel comfortable with that investment, so you lend me the 10 grand for 2 years, knowing these terms. So in year 1, let's say I crush it. I make 100% return. You guys are stoked. You have 10K, it turns into 20K at the end of the year. Well, in the second year, we start with 20K. Let's say I have some bad news. Let's say I lose 50%, which is okay, right? I still made 100. You'd think, right? Well, at the end of 2 years, I'm still back at 10 grand. But, I mean, if you think about it, 100% minus 50%, that's 50%, right, over 2 years. I made 50% over 2 years. So divided by 2, that's 25% a year. So I, as the advisor, did nothing wrong. I paid you 25% on an annual rate of return. Like I said I would. So you had 10K in year 1, and then you had 20K after year 1, and then you lost 50%, so you went back to 10K. So with that 2% management fee, you would have ended up with less than $10,000. I would have made 2% no matter what as the advisor. So let that sink in. This is what financial advisors and Wall Street does all day long. They can tell everyone how much money they make their clients every year, but on an annual rate of return, it's just false. And so this point is not that Wall Street's bad. Wall Street's fine. The point is that volatility can destroy your returns and destroy your expectations. If something is going up, it can feel like we're making money, but are we actually? So today, we're talking about the money multiplier method. This is this strategy that I'm going to show you that will change the way you think about money, and it will change how you perceive banks. We're going to talk about three things. The machine. This is how you keep your money flowing. We'll talk about this first. Then we'll talk about the marathon. This is not a sprint, guys. This process, this method is a marathon. It's going to take years to fully build this system out. It's not a get rich quick scheme. And lastly, we'll talk about everyone's favorite topic, your goal. The millionaire, the multimillionaire, being a business owner, having time freedom, whatever that goal is for you. Because everyone will really use different machines, the marathon might take different amounts of time depending on your goal. So keep all these three in mind. So what's the machine? This is the machine you're going to be using and build your wealth and keep the money in your family through a dividend-paying whole life insurance policy from a mutual company. What the heck does life insurance have to do with building wealth? It's because this is what the rich, the elite, the wealthy do. So just so you guys know who you're talking to as well, I will help you with this. I will build with you a policy. I will show you how to use it, what the strategy is behind why you're using it, and I'll help you with all of that. So let's start with that. Here's the dividend-paying whole life insurance policy from a mutual company. It's very important. But I don't want you guys to just believe me that this insurance policy is going to change your life. Let's look at other people who've done this. On the top left, you have the Rockefellers. They were the wealthiest family in America and effectively built this country. The reason they became so wealthy is because they stored all of their funds through whole life insurance, generation to generation to generation. Walt Disney on the right. Walt Disney started Disney with his life insurance policy. These billionaires on the bottom right, you guys know them as Warren Buffett and his whole empire of Berkshire Hathaway and many other billionaires. Right now, it's reported that of the ultra wealthy, they have over $1.2 billion in cash value in life insurance. And how about politicians? Sleepy Joe and Mr. Biden or Mr. Trump. If you look at Biden's financial statement, which came out when he became president, you will see on his statement, he owns 4 life insurance policies with a mutually owned company. So you know what's crazy about that? I mean, beyond these people that use this and the wealthy people that use this, the biggest purchasers of whole life insurance is banks. To become your own bank, we're going to just mimic what the wealthy do, what the banks do. Banks own more life insurance than all their land and buildings combined. Why? Is it because they're stupid? Or is it because they know something the rest of us don't? It's because they know something the rest of us don't, right? And this is not something that I invented. It's been around for over 200 years, like I've said. This concept, these life insurance policies, have been around before the tax code was even invented in the 1910s. If you guys look up BOLI, bank-owned life insurance, you can look it up. You can see hundreds of pages that come up regarding how much life insurance conventional banks own. I think right now, just for example, in Bank of America, they own over $22 billion of life insurance. Wells Fargo, over $18 billion of life insurance. You can find this. Now, how do banks work? I'll give you an example. Let's say I have $100,000 I go put in my bank. I'm going to assume my bank pays me a really good interest rate like the previous example. They pay me 4% on my bank. And if you find a bank that pays you 4%, let me know because that's awesome. But let's say the bank takes your 100K. What are they going to do with it? They're going to turn that money immediately into an asset. They're going to keep that money in motion. So they're going to lend it out to someone. And don't get wrapped up in these examples or these numbers. It's just the concept. Let's say you go over to your neighbor and they lend this money now to your neighbor to buy the house. The person, your neighbor, buys this house and they give the funds to the seller. What does the seller do? Puts the money back in the bank. And then now, let's say someone else, your other neighbor, wants to go buy a car. Well, they're going to lend that money right back out once the seller puts it in the bank, give it to the car or the person trying to buy the car. And what's the person buying the car going to do? Pay for the car, go to the car dealership. What's the dealership going to do? Put that money back in the bank. Another example, they're going to lend that money out now to your other neighbor for a home remodel on another loan. They're going to pay the contractor, and where's the contractor going to put his money? Back in the bank. And let's say your contractor got into some bad debt. So he goes to take out another loan to pay off his debt, pays off the credit cards, and then the credit card companies put the money back in the bank again. In this example, guys, who was in control the entire time? Banks. They had control of every single transaction, and they were constantly moving their money and making money. So while you earned 4% on your money, the bank made 7% on it. So that's a 3% spread they made on your money in that transaction. I'll get to these numbers on the left really quick, but we can keep going with that. When they lent the money out to the person buying the bank or buying the car, they charged 8%. Well, you're making 4%. They made 4% more than you on that transaction. And you can keep going with that. On the home remodel loan, on the debt consolidation loan, they made 8% more on you. So if you total all of those combined on this left side, they made 3% on you on the home, 4% on you on the car, 5% on the home remodel, 8% on the debt consolidation loan. They made 20% more than you on that, right? 20% and you're 4%. How many times does 4 go into 20? 5. So the banks made 5 times more money than you while your money was at the bank. They made 500% on your money. And you can look this up. Go to BauerFinancial.com and pull up any bank you want. Again, you can go to all their annual reports from any year, and that report will show you how much banks actually make on the money that you leave there. And so this bank made 400%, just an example, right? But every day, banks make this. Banks make between 400 and 1,300% on money you leave there. There isn't a bank that makes less than 400% annually on your money. It makes sense. If you go to any main corner in any town in the US, what's going to be the nicest property on downtown? It's always the bank. Every bank. Every time I go into the bank, I have a Wells Fargo close by. I always go into there. They always have some sort of giveaway for me. And last time I went, they actually had suckers. I can get whatever flavor I want, right? I go in there, they're depositing my money. I grab the sucker, I take the wrapper off, and what does it read on it while I'm sitting there at the bank? It says Dum Dums. Are they trying to tell us something? They know something we don't. The banks are always giving something out, and that's because they're making 400 to 1,300% on your money. But don't be mad at the bank. They've just learned something that you haven't learned yet, and you're going to learn how to become the bank. So earlier when I told you that these banks are the #1 purchasers of these specially designed whole life insurance policies, the thing I said was, are the banks stupid, or do they know something you don't know? You probably should know banks are not stupid. They know something we don't know. And not only that, banks understand statistics. So let's talk about the annual spending of money. So this is how most people spend their money. 20% of every dollar goes to automobiles, 30% of every dollar goes to housing, and 40% of every dollar for everything else: travel, entertainment, food. And then the last 10% is typically what people use to save. And as of about 2 years ago, the average savings rate was at 5 to 6%. So 5 to 6 cents on every dollar you make goes to savings. And prior to the recession, that number was actually negative. And most financial advisors talk to you about the money that you're saving, that 10%, or how much more risk do you want to take to make more money. And to get a higher rate on whatever you're saving, that usually involves higher risk. Well, if you can't save more and don't want to take on more risk, then what options do you have? how much more risk can you really take? So think about this. I'm just telling you exactly what's going on out there, right? So and I'm not going to talk to you today about how much you're saving. I'd rather talk to you about how much you're spending, because I'd rather take some of the money you're spending and show you how you can build wealth by simply taking back control of the money you're giving away. If you want to build wealth, look at where all of your money goes, and let's find a way to take back control of that money. So let me show you what that would look like. Obviously, you're 10% in savings. And on average of every 20 cents that you spend on cars, about 5% of it goes to interest. So let's remove that 5% from the automobiles and move it into savings. So I've just increased your savings now by another 5 cents to your previous 10. So I increased your savings now by 50% already. And let's talk interest. Even if you pay cash for a car, you take that 25K to go buy the car, take that out of your bank, and the car dealer now has your money. You're now, even if you bought it cash, right? Not even made payments, you just gave them the 25K, they have your money now. So you've given up control and the earning power, the interest on that 25K by using it cash to buy the car. So maybe the 5% doesn't come out of it, but it's on top of it possibly. So we can continue looking at that with the housing. Most people spend 30 cents of every dollar they make on housing, and of that 30 cents, about 25 cents of it goes to interest. If you move that into your savings, it would make a huge difference. If you own, all of your money is going to go to the insurance company, or sorry, to the mortgage company. So if you look at your most recent mortgage statement, I bet you the interest payment is not 5%, like they say your rate is. You have a 3% loan, a 4% loan. Is your interest payment really 5%? No, it's a lot more. Over 80% of your total house payment in the first 7 years goes to interest. And you know why banks do that? How and why they structure loans that way? Because they know how people actually because they know how long people actually stay in that house. And how long do most people stay in houses for? 5 to 7 years. So when we're buying a house, we get so hung up on the rate. It's not about the interest rate. It's about the volume of interest you're paying in the first 7 years. I'm just trying to get you guys to think about what's really going on here. So same with the 40 cents every dollar you save or you spend on everything else. 5% of that usually goes to interest. And so let me show you guys now how to get all the money back for all of your products and services that you're buying too. I mean, look at this. Look how much you're paying in interest that you could be saving. Well, in the system, we'll show you how to do that. So how to get all the interest back for all the cars you ever buy, drive, and own. So this is going to be our first example of showing you this. This is right here on the right is a policy. This is a dividend-paying whole life insurance policy. It shows you the age of the person, the deposits. We'll skip the next 2 columns. It shows you the cash value. I think I'm covering it, and the death benefit. So this person, you can use mine, use this Zoom as the line right here. So this person's putting in $10,000 deposits into his policy each year. He has a death benefit over here on the right, and the cash value is the amount of money he has access to use in his policy right away. He can take that money out immediately if he wants. Now, let's look at this machine here. This is the machine, the policy. These deposits, 10 grand a year, this is just an example. You do not have to do 10 grand a year. We can put as much or as little as you want into your policy. It could be $200 a month going in your policy. It could be $1 million a year going into your policy. And the premium, when you typically think about premium, it's a payment. It's health insurance premium. It's car insurance premium. It's life insurance premium. It's a payment for something. But I need you to change your mind a little bit when you're looking at this. When we build the policy for banking, the premium is more of a deposit. And the age, honestly, doesn't really matter. If you're 30 or 60, the deposits and the cash value will be relatively the same. It can be what you want. The death benefit, though, is going to be playing a big factor. That's going to be a lot more or a lot less depending on your age. So let's see how this machine works with an example. I'm going to show you how to get back every dollar for this car. And in this example, I'm going to say that you're planning to buy a car in the next 3 years for 25 grand. So if you put 10 grand per year into your policy for the first 7 years, just like that policy on that last slide I showed you, that's what we're going to do. So again, this premium deposit can be whatever you want, but don't look at it as a premium or a payment. Think of it as a deposit. In the third year, you're going to now go buy a car for 25K. Your cash value, the amount of money you can take out from the insurance company against your policy, that cash value is a loan that you're going to take out, and you will owe interest to the insurance company on that loan, but it doesn't matter because you are also earning a dividend on your dollars you put into the policy. That 10K you put in every year is earning interest. It is with an insurance company, a mutual company, and you're being paid a dividend each year. So your dollars are now in a safe asset growing. Your cash value is how much you have access to use, and it's in the form of a loan against the money you put in. And when you take that money out, it is going to be used however you want, and you can pay it back however you want, while your premium dollars, your deposit dollars, are still earning interest. So if that doesn't make sense, we can continue on that idea and keep talking about that throughout the rest of the presentation. But in this example, he buys a car in the third year for 25 grand. So in first year, his cash value is 5,800 of his 10K. In the second year, he has access to 12,000 to take out. In the third year, he has access to $29,204 to take out, which he does, takes out 25 to buy the car. So if we were to gonna just go buy a car, we were either going to finance it at a bank or going to purchase it cash. In this example, we're going to say you purchased it in cash. Took 25K out of your policy, went and gave it to the bank, bought the car. Now, if you were to take a loan from someone else's bank for 25K, you would pay that loan back with interest. So why would you not do the same thing to you if you're the bank? So if you take 25K from yourself, then you should pay yourself back with interest. So in this example, we're going to say you pay yourself back $500 a month. You pay yourself $500 a month for this car, and you pay yourself back extra with interest. And that money you put back in each month is actually going right back into your cash value. It's right there available for you to use again. And that's why your cash value you see on the right side continues to build. You're now depositing 10K in premiums and deposits. You're putting $500 a month back in to pay for the car you just purchased, and all that money is going into your policy, accruing interest, and you have access to it via the cash value loan. So over the next 7 years, he deposited $70,000 in premium. That went into his policy. He also put in $30,000 by repaying the cash value loan, and he took out 25 to buy the car. So in this example, we're going to say his net injection into the policy was 75 grand. That's what he put in the policy, and he has a car fully paid for outright, right? So after that 7-year period, he's put in 75 grand. And the total cash value at the end of 7 years, if you look at that, is $67,881. So if I'm doing my math right, $67,881 going into $75,000, that's 91%. So after that period of buying a car, you got back 91 cents on every dollar you put into this. And you got a car paid for outright. I told you you'd get all the money back for any car you buy. In this example, you just got back 91% of it. But that's not where we're going to stop. Let's keep going here. So now let's say after 7 years, he keeps his policy. He stops contributing it towards it, though, because of what's called a MEC 7 pay IRS rule, which that would be a question we can talk about individually when we're talking on the phone. But in this example, he was required to stop funding it. So after 7 years, he stopped funding it, no more deposits, but then he wanted to buy another car. Now a car for his wife. Takes 25 grand out, goes and buys the car. If you look at the cash value in the 7th year, it's 67,000. In the 8th year, it's 51,000 plus the 25 that he took out for a car. So it was what, 76? So takes out 25 to go buy the car in the 8th year. Does the same thing, pays himself back 500 bucks a month for the car, just as he should, if he's going to be an honest banker with himself. Now, after another 5 years, he's put in nothing in premium. He's put in 30K as loan repayments again. He bought a car for 25 grand. So net injection into the policy over that 5-year span was 5 grand. Now, if you look at the cash value, look at the cash value in the 7th year, 67,000. After that 5-year period, it's 91,473,000. So his cash value grew by $23,592. And he put in 5. He put in 5 and his cash value grew by 23, and he has a car fully paid for. So now, I'm just letting you think about that. So now after 12 years, we've got 2 cars owned free and clear. We've put a total of $80,000 net injection into it, 75 in the first 7 years and 5,000 in the next 5 years. So 80K total has gone into the policy. And we have 91,000 in total in the account. So if I'm doing my math right, we got back more than every dollar back for both of those cars you bought in that time frame. And you can stop at this point. So if you put in $80,000 and your cash value is $91,473, that means your cash value grew by $11,473. So you made $11,000 for buying 2 cars over that time frame. So did you indeed get back all the money for both the cars you bought? Yes, you did. Did you also have $91,473 in your account that you can now go use and buy another car with after this? Yes. Guys, this only gets better with time. But all I wanted to show you here is I wanted to show you that you can get all the money back for all the cars you ever buy, drive, and own. And I just proved that to you. I wanted to show you that you can get back all the money for all the cars you ever buy, drive, and own. And I just proved that to you, that this is mathematically possible. And I showed you exactly how to do that. And all you need to do is change one thing. And that one thing, that one change, is where your money went first. You're putting your money in a 401k, a savings account. You're in another savings vehicle. Here, we just changed where that money went first into this dividend-paying whole life insurance policy, structured the right way. Then we carried on and did exactly what we've been doing every day, every year of our life. This strategy doesn't change how you're spending your money. It doesn't change what you invest your money in. It doesn't change what you purchase, what car you want. It just changes where your money resides while you do those things. So don't change what you do, just do it through the policy. Now, there's 3 rules with this if you're going to do this. I wrote on the top there on the left. Rule 1, Rule 2, and Rule 3. To make this machine work the best for you, you got to follow these 3 rules. Pay yourself first. Pay yourself with interest. Recycle and recapture your money. You've been trained to pay your bills first and then take whatever's left over and put that into your savings, but that's the wrong way to think. Paying yourself first means that you put money into your savings and then pay your bills. And pay yourself with interest. If you're going to go get a loan with a bank, you would pay them interest, so why would you not pay yourself interest? That makes no sense. And you won't be able to recapture interest if you don't deposit it back in your policy. So, lastly, recycle and recapture. Would you agree that it's better to pay yourself interest than the bank? You'd get a lot more out of the interest if you did that, right? Now, if this works for a car, what else can it work for? Well, everything. Literally anything you finance, you purchase, you invest in can work the exact same way. So let's give you guys another example just to keep implementing this idea. We're going to go with a doctor. This is one of our clients. He's a 45-year-old doctor. he has 9 third-party debts. He has a Discover card, a Lowe's card, a Nordstrom card, a Wells Fargo credit card. He has a private loan to help him with his practice, a BMW, West Marine, which is a boat, because why not have a boat if you have a beach house? And he's a condo and a house. He has balances in each of those. He has a total amount of $478,000 worth of debt. And so we're looking at this, and he asked, can you help me figure out how to pay all this off through my policy and recapture this money? And we were looking at this. His total payments were $5,777 a month. That's $69,000 a year in debt payments. And we were looking at this, and we were looking at, well, how much do you save? And he said, well, some clients pay me cash, and he always saves his cash. He went through his numbers and his budget, and he found out about 25 grand a year he has extra that he puts into savings or in cash and just sets it aside. So we said, okay, well, let's just say we put that 25 grand a year extra onto each of these debts, and let's see how fast we can pay it off. It was going to take 19 years for him to pay off all that debt, which is better than 30 years to pay off the homes like it probably would have, right? He's paying it down much quicker. But here's what we're going to do instead. We said, well, great. How about instead of putting that 25K a year into your savings, let's put that 25K per year in your policy. So this person put 25K into his policy, and then he used the policy to pay off his debt. Now, so how did we do that? And we were paying off his debt much quicker, and I'll show you. So deposits 25K. His cash value, which is the amount of money he had access to take out as a loan from the insurance company, it was $14,863. So of that 25K he put in, he had access to 14,000, right? And he can take that loan out immediately, right off the bat, take that money right back out and go use it. He used it to pay down his Discover card and his Lowe's card and a little bit of the Nordstrom card. So he freed up those payments of $161 a month for the Discover card and $287 a month for the Lowe's card. Freed up that money, which is great. So of his $5,700 of payments every month he had, now he only has $5,300, and he's now saving an extra $448. So what's he going to do with that extra money? Well, I'd recommend that you put you're an honest banker with yourself, and you pay yourself that back. So you put $448 a month in a separate bank account, and make sure you save that money and pay it back to yourself one day. So in the second year, he's going to deposit another $25,000. Puts in 25. His cash value that he has available to use increased to 16,000. He takes 16K, and he also repaid himself $448 a month. So his repayments, the payments here, show $5,374. Over the year, that's what he accumulated. So in the second year, he has a total cash value or total cash available of $21,994 or $945. He now takes that money and pays down his debt. Pays down the Nordstrom card, the Wells Fargo card, the private loan, and some of the BMW. Now look at the payment switch. I'm going back and forth here. It was $5,300 in monthly payments. Now he paid off some of the debts, so now he pays $3,860 in payments, and he saves $1,900 a month now. That's more money he freed up each month, which he can now pay himself back each and every month. Now the third year comes around. He puts in another $25,000. His cash value now, though, is $25,541. Because remember, he's earning interest on the full amount the entire time. So each year he has access to more and more money. So his cash value is $25,000, and he repaid himself every month in that separate account, and it built up to 23 grand after a year. So he has a total cash available of $48,000 to now use to pay down his debts again. Pay down his BMW, his boat loan, and some of the condo. He's down to just 280 grand of debt. Guys, in 3 years, he's got everything gone except the two big ones, the condo and the house. His payments now switched over to having more he saved. Now he only pays $2,100 in payments and saves $3,677 that he now pays himself back each and every month into his policy. So let's recap this really quick. I mentioned earlier it's a marathon. We're not miraculously paying off all your debt right away. We're not making a ton of money for you. We're just changing where your money went first before you paid your debts down, and how and what order you paid them down in. Now, if we keep going here, how much did we put in over that 3-year period? 25 in year 1, 25 in year 2, 25 in year 3. How much did we take out as loans? Took out 14 in year 1, 16 in year 2, and 25 in year 3. So we put in 75, and we've taken out 55. This means we should have what? 20? Well, I can ask the question to you guys first. How much is left in your policy? It means we should have 20K, right, in the policy, right? 75 you put in, 55 you took out. Wrong. Remember again that we're not borrowing the money that we've put into the policy, but instead we put that money up as collateral for a loan against the general fund of the insurance company, and we are using that to go pay off our debt. The entire 75K is still in the policy, still left in there, earning a dividend while you pay your debt down. We'll keep going with this. In the 4th year, you now have a cash value of $70,000. I'll hide my screen again. Because 26K of cash value was available, you paid yourself back every single month again in that separate account, so you had a total of 70K. Take the 70K, pays down the condo. Not fully, and the payment didn't change because you didn't fully pay it off, so the payment still stayed the same. So in the next year, puts in 25 grand again. He has 27 in cash value, 44 in repayments, so he has $71,000 of money available to pay down his debt with. Pays down the condo, pays off a little bit more of the house, frees up more on a monthly basis, and pays himself back a lot of money now, $4,556 every single month he's paying back to himself. Now, in this next year, I mentioned earlier what's called the MEC 7-pay rule that applied to this person as well. He had to limit the amount of contributions he had into his policy. So his premium dropped from 25 grand a year to 10 grand per year. And he also was like, hey, Carson, I'm loving how the system's going. I'd love to put more of our income through it. So he ended up getting a second policy for 25 grand a year again. So now he has one with 10 grand per year and a second for 25 grand per year. And he's doing both. And I like to look at this as building another branch to your banking system. You look at Wells Fargo on the downtown Main Street, they have another one 2 blocks over. As you build up, you're going to add more and more policies. So just like he did, he got a second policy doing another 25 grand per year. So he put in 10 and 1 in the first one, and his cash value grew by $13,000 because it's had 7 years to compound his cash values more and more. He had access to 30% more than what he put in. Now the second policy, 25K in premium, back to the start, another 14K available. So $54,000 of repayments as well, because he was paying himself back all those monthly payments. So there's 82 grand available to pay off the house. Halfway through the 6th year, his debt's paid off. Right? That's the story. So if we continue on this, let's talk about now the millionaire. Talked about the machine, talked about the method. Now the millionaire. What if I have no bad debt? Carson, what if I don't need a new car? Can I still benefit from privatized banking? Should I still become my own banker? Should I still get a whole life policy? Yes. I personally just, I don't have any debt. I don't have a new car I need to buy. I'm doing this myself too. It just gets more fun. Now I don't have things I need to work on. Now I'm just building up funds to go make investments. Now I'm buying real estate. Now I'm lending money out. You can continue to just build and build on this after that debt's gone. Now, this is just another example for you guys of how a policy was built. It shows you on the top, in year 1, he dumped in 50 grand. And this premium he had, his deposits were $5,895 per year. It was like almost $500 a month in premium. This person dumped extra money in, 50K to start, and then he wanted a smaller annual premium, a smaller monthly amount, because that's what he could have done with his income, but he had some money in hand he wanted to start out with. So he did that. He did a large dump in, we call it, and an annual premium. His cash value in the first year was 51,000. So he had access to about 90% of what he put in immediately to go use. In the last example, he had what? He put in 25K and had access to 14 in the first year. Well, in this example, he put in a lot and had access to 90%. So depending on how you want to structure it, depending on what we're trying to accomplish, we can build the policy any way we need. And you can see each and every year, in the second year, the fifth year, the 10th year, the 15th year of his policy, the cash value growth exponentially increased. Now, the machine works for anything: taxes, expenses, vacations, homes, taxes, everything. This is called the infinite banking concept because there's an infinite amount of ways to use this. So let's go back to that example, and we're going to continue to pay down those two debts. If you were going to continue paying the condo and the house forever, or until your loan was paid off, that guy would have had to pay $879 a month for another 250 months, and he would pay the house $1,200 a month for another 224 months. Now, he's going to be an honest banker with himself, and instead of paying that to the banks, now he's going to pay himself that. So he's paying himself those payments each and every month. Now, after all of those payments were done, he had paid himself back almost $500,000 that he would have given to someone else. By using this strategy, you now have all of that money in your pocket rather than the banker's. Last couple slides here, guys. By the way, I didn't mention a few things. I talked about the death benefit briefly in the beginning, but it's tax-free and it creates a legacy for your family. And that's a huge benefit on the policy. The loans you take never have to be repaid because they're going to be against your death benefit. If you were to pass away, the death benefit will be paid out to your family minus the outstanding loans. Your policy is going to grow tax-free. All the returns in your policy are tax-free forever. It's in a tax-free environment while you're using your funds via a loan, because you can't get taxed on a loan. And lastly, your policy is safe. If you're ever sued in a lien lawsuit, your money is completely safe in the policy. And so you're now storing your money in a guaranteed to grow, tax-free, safe asset with a death benefit. And we can keep going with more and more. You decide how much you fund it. You can decide what the premium is. So real quick, guys, only two things are going to happen in your life. You're either going to live or you're going to die. So if you live, are you better off with or without this? As you can definitely see, you're better off with this. You can pay debt down faster. You can buy things and get money back for them. You can multiply your money in real estate deals. So you're better off with this than without. And all of us are going to die at some point. So is our family better off with or without this? With this, your family gets a tax-free death benefit, and your death benefit is always a multiple of what you've put into the policy. If you were to just leave money in a bank, your dollar is a dollar. You're not guaranteed to get anything. Your family is better with this. And lastly, I want to leave you guys with a quote from a man named Warren Buffett, who I'm assuming all know. He says, if poor people would just do what rich people do, they wouldn't be poor anymore. You know what company he owns? Berkshire Hathaway. It's also an insurance company. And I wonder why he does that. Today I talked about the wealthiest families, the Rockefellers, the Rothschilds, Walt Disney, Biden. The list goes on of wealthy people, rich individuals, rich families, banks, corporations that do this strategy. So if you would just do what they do, you wouldn't be poor. And in fact, if you are poor, if you're doing well, you're wealthy actually, then you just saw a way to finance things, purchase things, and multiply your money and protect and save your money better than any other way you can. So I look forward to helping you guys. You can schedule a call with me or my team, and there should be something somewhere you can click a link to talk with me. But the call is free. I don't charge anything. I don't even charge anything to help you do this. I just facilitate everything for you with the insurance company. I will help you build a policy for your situation. I will help you plan how to pay off the debt. I will help you build the whole system out so you can do this and become your own banker yourself. So we teach this concept. We're not here to sell you a policy. You do need the policy to do the concept, and that's what we'll help you with. So I hope you guys got a ton of value from this, and I look forward to helping you with whatever you guys need help with. Thank you.